Islamic banks are more resistant to crises than conventional banks. The global financial crisis of 2008 had significant effects on both Islamic and conventional banks, albeit in different ways. Here are some of the key differences between how the crisis impacted these two types of banks. 1. Risk management. One of the key differences between Islamic and conventional banks is their approach to risk management. Islamic banks operate on the principle of profit and loss sharing, which means that they share risks with their customers. In contrast, conventional banks typically operate on a fixed interest rate system, which means that they bear the risk of default on loans. During the financial crisis, this difference in risk management approach meant that Islamic banks were generally less exposed to the risky lending practices that led to the crisis. 2. Asset quality. Islamic banks also tended to have higher asset quality than conventional banks during the crisis. This is because Islamic banks typically focus on asset-backed financing, which means that their loans are secured by underlying assets such as real estate or commodities. In contrast, conventional banks often relied on unsecured lending, such as credit card debt, which was more vulnerable to default during the crisis. 3. Liquidity. During the financial crisis, liquidity became a major issue for both Islamic and conventional banks. However, Islamic banks were generally better positioned to weather the crisis because of their reliance on asset-backed financing. This allowed Islamic banks to utilize their underlying assets to generate liquidity during the crisis, whereas conventional banks had to rely on government bailouts and other external sources of funding. 4. Growth potential. Despite the challenges of the financial crisis, Islamic banks continued to grow at a faster pace than conventional banks in many countries. This is because the crisis highlighted the limitations of conventional banking practices and increased demand for alternative financial models such as Islamic finance. Overall, the global financial crisis had significant effects on both Islamic and conventional banks, but the differences in their risk management approaches, asset quality, and liquidity positions meant that Islamic banks were generally better positioned to weather the crisis.